Chapter 6, Inventories. So inventory often makes up one of the largest current assets that any business owns. And it is often also the most one susceptible to loss. So there are various controls that businesses use, one of which to control inventory is called the three-way match. And what the three-way match is before accounts payable issues a check for the purchase of inventory, first there must be a request by the inventory control department to order new inventory. Oftentimes this is done automatically with modern systems and point of order quantities. That then goes to the purchasing department, who looks up and puts out a request for quote to various authorized vendors. Then they select the vendor, not necessarily based on the lowest price, but quality, experience in the past, various items. And then a purchase order is let. That purchase order outlines the quantity of the item, the particulars, the description, part numbers, as well as the price that is agreed upon to be paid. Then the material is packaged up and shipped by the vendor and arrives at our receiving dock along with a packing slip, a receiving report. This packing slip has the item description, part number, and quantity. It does not have price. The receiving personnel then count, ensure that the quantity that was shipped was indeed the quantity that was received, and then that report gets forwarded to the accounting department. The purchasing department also forwards a copy of the purchase order to the accounting department. Then the vendor sends an invoice charging the agreed upon price multiplied by the agreed upon quantity for a total, as well as any shipping that may have been to be charged. And those three are then matched. So as long as the quantity ordered is in fact the quantity received, is in fact the quantity charged on the invoice, and then the agreed upon price for the purchase order matches the invoice, then the invoice is authorized for payment. So that's what this says. So inventory can be accounted for in one of two main methods, and that is perpetual or periodic. Perpetual inventory is every time an item is received or an item is sold, then the inventory quantity gets updated. With the advent of new computers, even small retail organizations with point of sale software allows them to use a perpetual inventory system. A physical inventory is one that is taken at year end or on a rotating basis under a perpetual system. It is taken at year end and quite possibly quarterly under a periodic system, which we'll talk about here shortly. So the cash flow assumptions that we're going to cover in this chapter consist of three different methods. The first is first in, first out. Secondly is last in, first out, LIFO. And then third, weighted average. So first in, first out is items as they come in order, are then sold. So you have the oldest item in stock is the one that is in fact sold. And a physical example of this is a candy machine. So a candy machine has a little corkscrew and items in there, and you put in your money or your credit card, and you press G7, and you get a bag of M&M peanut candy. That's first in, first out. As the candy machine gets restocked, the delivery driver opens it up, puts the new candy in the back of the corkscrew, and so at any one point in time, you are in fact buying the oldest piece of candy in the machine. Last in, first out is LIFO. That means the most recent items of inventory are the ones sold. And a good example of this is a big pyramid of soft drinks stacked up in a grocery store. At the end of the day, when that gets replenished, they don't take the old inventory sitting down at the bottom and pick it up and put the new inventory down at the bottom of the pyramid. They just place it on the top. And then as people want to buy one of the packs, 12 packs of soda, they just buy it and they take it off the top. So that's last in, first out. And then lastly, weighted average. Weighted average is a mixing it all up. A good example of that is a gas station. So a gas station has diesel fuel and low lead, various types of no lead gas based upon octane, and they're all stored in separate tanks. So as the new gas comes in, the tanker truck pumps it into that tank and it gets all mixed up together. So that when you buy a gallon of gas, you're buying a little bit from the most recent delivery, but you're also buying a little bit from a delivery possibly a year ago, all mixed in together. So those are the various cost flow assumptions. So let's look at a very simple example. We bought 3 items of inventory, each time only buying 1 item. They cost the May 10th on $9. On the 18th, the price had gone up to $13. And on the 24th, the price had increased once again to $14. Total cost of inventory available for sale during May was $36, consisting of 3 items, which was an average cost per unit of $12, the $36 divided by the 3 items. So assume that 1 unit is sold on May the 30th for $20. So which one is it? If it is the unit from the purchase on May 10th, that's $9. And that gives us a gross profit of $11 and a value in ending inventory of $27, the $13 item and the $14 item. If we in fact sold the one that we purchased on May 18th, that gives us a gross profit of $7, leaving us with $23. And if it was the last item, it was $14, giving us a gross profit of $6 and $22 in ending inventory. So the first column on May 10th is FIFO. The last column on May 24th is LIFO. If we did May 18th, that's specific identification. And specific identification is used for typically high-end individual items. An art gallery would use specific identification. All the sculptures and the paintings, they would know precisely what they paid for them in order to cost it out for sale. Diamonds and jewels are also specific identification. Diamonds are all serialized, so they know exactly what the cost of the diamond is. Okay. So inventory costing under the various methods. Under FIFO, you sold the very first item, so $9, leaving us with the last 2 items. Under LIFO, you sell the last item, leaving us with the first 2 items. And then average cost, you sell, the cost of goods sold is $12, leaving us with 2 items of inventory times 12, or $24. Under a perpetual inventory system, I cost out the items as they're at the end of each month, and we base that at the end of each sale, and we base that based upon which of the 3 systems. So under FIFO, we have a beginning inventory of 1,000 units at $20. We then sell 700 of those. Those cost $20 because we only have one pool of inventory to buy. Then we buy 500 at $22.40. So now we have 2 pools. Under FIFO, when we sell 360 units, we sell the remaining 300 from the beginning inventory, and then 60 of the 500 that we just bought at $22.40. Then we make another sale of 240. Now, once again, we only have one pool because we sold 60 of the 500, leaving us with 440. So when we sell 240 of them, they're all sold at $22.40 of cost. That leaves us with 200 remaining. We have that 200. We buy on the 30th an additional 600 units at $23. And that is what is in ending inventory, a total of 18,460. Add up the total cost column, that gives us our cost of goods sold. So this is the ending balance from the January 10th purchase, 200 units left over. Started with 500, we sold 60, and then we sold another 240, leaving us with 200. Under LIFO, the initial sale is still the same because there was only one layer, the 1,000 units that we started the month with on January 1. However, when we purchase this additional 500 units, we now have 2 layers. So when we sell on the 22nd of January 360 units, they all come from the last in, first out layer. So it's all $22.40. That leaves us with 140 in that layer and still having the 300 from the beginning inventory. So that when we sell 140 units, that wipes out that purchase that was made on the 10th. So now all of that inventory is gone, and then we sell an additional, because we sold in total 240 units on the 28th, we sell 100 of the 300 that we had left over, leaving us with 200. Add in that last purchase, now ending inventory is $17,980, and cost of goods sold is $27,200. Here's ending inventory under LIFO. Weighted average is a moving weighted average. So when we sell, the first sale is always the same. It's all at $20. But now we have 300 units. We're going to, that with a total cost of $6,000, we're going to add 500 for a total of 800 units. Add the 600 to the purchase cost of $11,200, gives us $17,200. Divide that by the 800 units available, and we get an average cost of $21.50. That is what is going to be used for the sale on the 22nd and the 28th, leaving us with 200 units, total cost of $4,300. Add in the 600, we have 800 units total. The $4,300 plus the $13,980 is $18,280. Average cost now of $22.85. Under a periodic inventory system, the cost of goods sold calculation is made only once per period, at the end of the accounting period when we need to produce financial statements. So what we do is we start with beginning inventory, we add in purchases that were made throughout the year, throughout the period, whether it's a year or a month or a quarter. That gives us total units available for sale. We add the beginning inventory cost plus the cost of all those purchases. That gives us total cost of goods available for sale. And then we subtract the items that are left in ending inventory. So we go out and we count everything on the shelf, and that gives us the number of units sold during the period. So here's a simple example once again. It's a beginning inventory of 1,000 units, a purchase of 500 and a purchase of 600. This is the same that we just did under the perpetual inventory system. So available for sales, 2,100 units, $45,180. So under FIFO, we have 800 units in ending inventory. Those are the 600 that were purchased on the 30th, and then 200 of the January 10th left. Total inventory cost value of $18,460. Subtract that from the cost of goods available for sale, that $45,180, and we get cost of goods sold of $26,720. Here's a graphic illustration of it. So we have 3 blocks of units, the total of which make up 2,100 units at a total cost of $45,000. We identified the 200 and the 600 units from those 2 blocks and calculated what ending inventory value was. Subtract that from the 45, and that gives us cost of goods sold. Under LIFO, we calculate the ending inventory of 800 units from the beginning. So we still have 800 units, but it's the 800 that we started the month with. We know that those each cost $20 a piece. That gives us $16,000. Subtract that from the total cost of goods available for sale, gives us $29,180. So this is the 800 units that are left in ending inventory. 200 were sold, all 500 were sold, and all 600 were sold. Then weighted average is that we calculate the total 45,180 units divided by 2,100 gives us $21.51, 800 of which are ending inventory, and the balance of 1,300 units are cost of goods sold. So that's this. 800 units, subtract that cost from the total, gives us 27,000. And that's it.